great panel of real-world receivables and trade finance experts that leverage technology, leverage their experience in the field, having seen what works, what doesn't work, and trying to build something significantly better. Today we have Tim Armstrong, who's a co-founder and the head of receivables finance at Sten, a business-focused, Silver Birch Finance. Mix that up for a second. Silver Birch Finance, which is one of the more recent ambitious projects focused on inventory and trade finance. Then we have Chris Rigby, who's the CIO and CFO of Sten, and he will tell you more about their global capabilities when it comes to receivables and trade finance. And we have Kartai Baidar, who's the executive chairman of TAB Factoring, part of BNP Paribas Group, and also vice chairman of FCI. Please welcome them to the stage. Thank you. All right. So let's maybe start with a very quick introduction. Tell me more about you as a person, not about your company, but you as a person. Karta, you want to start?
Thank you. Is this? Yeah, you hear me? Yeah.
We can hear you.
Thank you very much. It's very nice to be here with you. Thank you, Michael, for the invitation. I'm the executive chairman of TAB Factoring, which is a subsidiary of BNP Paribas Group. I managed the company 15 years as general manager, and then starting from this year, I'm in the position of executive chairman. In 2011 and in 2016, I have been chosen as the chairman of FCI, and I spent 4.5 years to act as the chairman of FCI in factoring industry. So I'm one of the pioneer of factoring industry in Turkey. I started the factoring industry in 1990. So it makes 32 years of experience in this industry. So thank you very much.
And when you're not in factoring or working in factoring, what do you do?
Sorry?
When you're not working in factoring,
I'm an international water polo player.
Water polo.
In fact,
Right.
yes.
We have a water polo.
I played in Turkish national team when I was young, and now I'm playing in the second division officially, and in the masters team of Turkey. So I'm playing tennis as well, but my core sport is water polo, and I'm still working in the management level of the federation.
Fantastic.
This is my biggest hobby. I'm married. I have one child.
All right.
And I'm a Fenerbahçe supporter.
Fantastic. Chris, how about yourself?
I can't compete with water polo, I'm afraid. I'm pretty average at chess. Does that count?
Can apply.
Yes, I am Chris Rigby. I'm a sort of career banker that's trying to reinvent myself in the world of fintech. But I worked at HSBC and Lloyds for a long time, mainly in asset-backed and fixed income markets. And have been at Sten for about 3.5 years now. And we'll talk more about Sten, I think, later. But yeah, my second day job is looking after 2 high-maintenance children, but we'll come on to that later.
All right. And then we have Tim.
Hi, Tim Armstrong. So I started my career as a soldier in the British Army, as an engineer, so building bridges, and then much more fun blowing them up again, which was very enjoyable. I then went to Merrill Lynch and then Morgan Stanley, working in their securitization teams. So I used to work here in Canary Wharf a long time ago. Then when all of the vehicles that we built ran into problems in the previous credit crunch, I worked on the structured investment vehicle desk, if anyone knows that particular product. I went to work for Deloitte, who were appointed the receiver of those vehicles. Goldman Sachs had been appointed to formally wind up those vehicles under Deloitte's leadership. So I was there helping keep Goldman Sachs honest in those situations, which was entertaining. I then moved into the digital team within Deloitte and then moved to KPMG in a kind of digital and corporate finance overlap. where I set up a partnership with a company called C2FO, who I'm sure some of you know, in this room. And that's where I started developing my interest in trade finance, in the technology capabilities that you bring into the trade finance world. Then I moved through a fintech that had some challenges, and then I've set up Silverbirch with a group of other people.
Fantastic. We have a lot of topics to cover here, so let's jump right in. So myself as an entrepreneur, I'm very often asked, what is the core problem that I'm trying to solve? What is the reason that your business exists? Tim, you recently, or I think you're the most recent entrant in the market from all of us. Why do you exist? What is the problem you're trying to solve, and how do you do it better?
So what we try and do as our USP, if you like, and it probably isn't that unique, is we try and tailor our solutions to exactly what the clients require. So if you think about my career, so starting off in securitization, I obviously love and have enjoyed working on securitizations in my career. And they solve a huge amount of problems for a very wide range of corporates and finance providers, and they're very useful and effective tools. But they're not that flexible. They come with certain ways of behaving that are imposed on the corporate, which means the corporate has to adjust the way they do things in order to fit in with the securitization more than the other way around. You'll also find in the receivable financing space that there will be receivables that aren't eligible for the securitization for whatever reason. It could be that there are buckets, particular size buckets for certain types of receivable, or certain receivables just don't work for that particular securitization. So securitizations are relatively inflexible tools as an example. So we try and provide something that is more flexible, maybe based on data analysis. So you've got a really precise understanding of the risk in the receivables portfolio that you're buying. So that's kind of what we try and do across both the receivables and the inventory finance space.
All right, so I hear bespoke solutions, a lot of tailoring, and more flexibility than the traditional lenders out there.
Correct.
Okay. How about Stan, Chris?
Well, I think our purpose, as we're a platform, I probably divide my answer into two categories. There's the value or the problem that we're addressing from a demand side of the equation, which is where can exporters, where can small and medium-sized businesses across the world, where are their pain points in accessing capital? And I think it's probably not too controversial a proposition to say that there's a huge trade finance gap in the world in terms of what's the served portion of the market by the traditional banking industry and where is the gap in terms of underlying need. And so part of our proposition is to really find those clients and access them in a scalable and technology-friendly way so that they can be assessed and rapidly evaluated. On the sell side of our platform, if we're going to be useful to those corporates, we need to have capital, and we need to have capital that has a clearly defined risk appetite and can be accessed quickly. So on the sell side of our platform, we're only useful to the sell side if we can deliver strong risk-adjusted returns. And so in both cases, whether it's sourcing the client and effectively mining that arbitrage we're finding risk and risk at a price that the buy side or traditional banks can't access or choose not to access because of their restrictions either on credit appetite or leverage or compliance burden effectively. So our reason to exist is to connect those two pockets, illiquid or underserved client with capital that is plentiful but tends to be pointed at more vanilla areas. And by using technology and by applying risk decisioning, we can hopefully make that fact pattern much clearer to both sides.
Okay, we'll come back on the technology later on. Kartai, one thing we're hearing here is capital, right? You're obviously part of BNP Paribas Group, so you do have a balance sheet, you have a capital muscle there. Is that one of your advantages, let's say, in this market as well?
First of all, let me give you one figure about trade finance gap. It's $1.7 trillion.
There's no lack of market. Yeah.
So everybody has potential there, and there is a need. So yes, our group, BNP Paribas, or any group, or traditional lenders, we have to fill this gap, $1.7 trillion. So Although we have traditional lenders, we have banks, we have factoring companies, there is still a gap. So we are here to compensate, to fill this gap. And especially SMEs, they are really looking for extra funding, not only from the traditional lenders, not only from the factoring companies, from the fintechs, from platforms. So there is still a way to go, and there is a still need to fulfill. So at the end of the day, we have big responsibilities to fill this.
And maybe once, if you're talking about SMEs, what are some of the reasons, for instance, your organization will reject them for funding? What will be some of the reasons your organization would reject an SME for funding?
I would like
Chris
to...
is mentioning
I
that
will- yeah.
sometimes banks have certain constraints.
Our banks or traditional lenders are more conservative and regulated companies. And this is why the rating of the SMEs, the collaterals of SMEs, the balance sheet structure of SMEs are important for these traditional lenders and for these banks and for us as well. I mean, we have a rating scale for which we allocate funding. If the SME is below such a rating, then we stop doing the... So, and then, since the big regulated banks stop doing funding, there is a room for factoring companies, then there's another room for fintechs and platforms. So unfortunately, for me, as a factoring professional, I think the traditional banks doesn't understand the value of the trade finance receivable, or they still need to understand and they still need to give importance to that. So we as factors, we are very flexible, we are very fast, we are very agile as fintechs, and then we are going to SMEs and we are filling their needs. So which is, I think the factoring companies and this receivable finance industry played an extremely important role to make SMEs survive.
Okay.
So I think this is the business management and mentality of the big banks who prevent them to fund more the SME industry. In short.
And I will come back on also some of the underlying reasons. One of the hardest bits, as many of you in the audience also know, is how do you run cross-border programs? How do you run a receivables finance business, potentially payables finance business, at a global scale? And I think both Silverbirch and Sten have experience in that field, and I think that's very fascinating. Tim, how do you go about running these programs at a global scale, where very often more complexity exists in a cross-border setting?
So in every case, we focus on the individual client's needs and requirements. And every client, regardless of where they are, has their own unique set of challenges and problems and priorities that they want to achieve by the working capital solution that we're discussing with them. And a subset of that is the idiosyncrasies of the particular region that they're operating in. So by treating every client situation as a kind of unique client situation, we then address those problems as part of the structuring of the facility that we put together. And when we combine that with the way that we operate, and I know we're going to touch on this a little bit later, which is through partnerships, by creating and adopting the right partnerships, potentially in particular jurisdictions, you can combine the experience and expertise that we have with the potential for already having solutions to particular regional challenges that a partner might bring.
From what you're saying, it sounds like a very bespoke, tailored solution to the client needs. How important is technology in that setup and the ability also to have a global program?
So technology is really important because it allows you to first of all, properly track the risk that you're getting exposed to. You can be, as Gagatai said earlier on, you can be really nimble in identifying the types of risk that maybe exist within the client's setup. We specifically look as part of our business at portfolio receivables solution. So using technology, using data analytics, as we do, we can assess and analyse quite a broad range of a client's customers, client's historical behaviour, and then both understand the risk within that portfolio and also identify the bit that we want to buy and get exposure to, and then how we and then figure out and structure how we then bring our investors into the situation. And then once we've done that, what the technology allows us to do is track that risk over time as that risk evolves, and allow you to know where situations are arising, where problems are occurring, and then to have a strategy to address those risks as they change and evolve.
Okay, managing risks, especially in a changing macro, sounds important. Chris, let's say on a scale of 1 to 10, how important is technology for your clients when they make a buying decision, so to speak?
It's interesting because I'd say technology is a 10 for us, but we're also an investor on our own platform, so our interests are aligned with those of our investors. I would say for a client in and of themselves, if you're a Vietnamese apparel manufacturer, you're not necessarily worried about how great Sten's kit is. You want to be able to have a user interface that is friendly. You can upload your invoice, you get your money in 48 hours, but it's more about traditional merits of speed, certainty, capacity. The fact that technology enables us to deliver that really is a secondary importance to a client. But I think for our investors, they may well appreciate that the burdens of AML, KYC, compliance, credit risk underwriting can only be obtained in those situations because of superior technology. So I think possibly the perceptions of value for tech are different on different side of the platform, but essentially we wouldn't be able to deliver value to our clients without technology.
Okay. In Carta, a business like Sten is building up its technology from the internet up, from scratch. For banks, very often they have an existing system which usually looks a bit like lasagna, right? With a lot of layers built up over time, or they white label or license a external system. Is that one of the opportunities out there for entrepreneurs to build a better system and this way, let's say, take away some of the inefficiencies that may exist in a bank?
Yeah. Let me refer to Accenture's report about how banks can grow their market share. The first point from this report is that banks will need to invest in digitalization, in automation. Second, they must forge technology partnership. And the third one is they have to adopt sustainable financial process. At the end of the day, the technology for the banks becomes much more important to have a bigger clientele, to increase their penetration in especially in SMEs region. And then the banks either original from their own system, which is quite low, and I must say traditional, they have to cooperate with these new platforms, entrepreneur, technology, fintechs, in order to have a quick access, quick product delivery to their customer portfolio. So I think it's becoming a much more vital, especially we see that during pandemic period, that the banks need to be more agile and digital to reach their customer who stays at home, who doesn't work, who doesn't go to business. So it's becoming much more vital and important to reach them via technology, and then I'm really recommending the banks to be in cooperation with these new entrepreneur and fintechs.
And bank partnerships has come up a couple of times here at panel also, I believe in previous editions of this event. It's really hard. You see a lot of people speaking about bank partnerships to the extent that to me it always feels a little bit like, a bar talking about sex, right? We all like to talk about it, but back in the bedroom a lot less exciting stuff happens. How do fintechs and banks, how should they partner? What is your advice being at a...
First of all, fintechs can help banks for client acquisition.
Okay, so you're saying the banks obviously sit on the customer base,
yeah,
and this is something they should leverage.
Exactly. And then the fintechs can change their operational system. Our operational system in the banks are more, let's say, slower than the fintechs. However, new fintechs can reach and can raise new products for operational excellency, for credit allocation procedures, which since they are unregulated or not that regulated as banks, they have much bigger opportunities, much deeper opportunities than the banks, and this gives banks a big opportunity.
Yeah. And Tim, is, for instance, one of the ways you originate or distribute your product?
100%, yeah. And so the way I think of bank partnerships is a bit like the way I used to think of having multiple sexual partners, just to kind of surf on your point. And actually, you have to have a different technique or approach with each one. If you go in with the same approach,
wise horse.
every time, no matter how good you think you are, it might not always succeed. So we have a range of bank partners that we work with.
Yeah.
In some cases, the bank introduces us to clients and we're the product guy. In other cases, we introduce the client to the bank and the bank is just the funder. Some cases, we run on our rails and the bank literally plugs in the funding to our rails. In another case, and our probably most successful partnership, we run entirely on the bank rails. And the bank buys the receivables, the bank gets the benefit of the relationship with the corporate, and we just do the analysis on the side and have a kind of service contract with them. So be flexible, have a range of different approaches, and don't have too big an ego as well. Don't worry about who has the client relationship, because if you're adding value to the process, you'll be invited back time and time again. If you're not, then you've got to change what you're doing so that you make sure you are invited back time and time again. Doesn't need your name to be on the tin necessarily.
Chris, do you have a similar approach when it comes to this?
Quite different, actually.
Partners?
I'm not going to try and perpetuate that metaphor at all. But in terms of commercial partnerships, we've got a slightly different philosophy at Sten. So we have a well-publicised strategic partnership with Citi, and there's a very clear alignment of interest there because we fill in a product gap for them, and there's a very clear overlap in terms of global footprint and what the problem we're trying to address. Our view on it is that partnerships have a great value because they make tailoring effectively, commercially, economically sensible. It makes sense to invest and tailor your product in the situation where you can be guaranteed flow. And I think for a bank where they have gaps in product or technology gaps, that there's a clear benefit to using fintechs and outsourcing some of that execution risk. From the fintech perspective, if you get a pre-screened Citi client base, that's not only a fairly strong volume guarantee, but it's also risk enhancing as well. Indeed, I think the danger of it from a fintech perspective is that, particularly when you partner with very large, successful, sophisticated organisations, there's a danger that you have to stick to what you believe is the right product to build for the street. There is a point which tailoring is useful and delivers value to your client base. There's a point where you can just get pulled into what is today's flavour that is required from a bank partner. So there's always a balance there. But clearly they have value. I think it's interesting to hear that there are some models that make an intrinsic good out of a partnership, and those where I think it's complementary to a wider strategy.
Carta, do you think eventually the bank should buy a business like Sten?
Possible.
Let's talk valuation.
That's exciting. Is that potentially the best way for a bank to accelerate their efforts if the partnership indeed is too slow or too difficult to get right?
I think it could be very useful.
Okay. Well, I guess it depends on the price.
But there's a danger there. There isn't. I mean,
okay. What do you think is the danger?
So one of the reasons why partnerships they're really hard, but when they work, one of the reasons why they work really well is that you bring the nimbleness of the fintech company and combine it with the brand name and the stability of the bank. And part of that brand name and stability comes from the fact that they have processes and legacy systems that have been laid down for a long period of time that are stable and don't change. So the bank gets the benefit of being a bit more nimble, because as you say, that the fintech or the partner doesn't have to follow those processes necessarily if the partnership's been set up well. As soon as you absorb the fintech into the bank, they then have to start following probably the processes of the bank. So you lose some of the benefits of having a partnership. In fact, you cease to have a partnership almost by definition.
I've seen some banks when after they acquired a fintech or a non-bank lender keep the entity entirely separate, also with a separate license to avoid some of this difficulty. Are there any questions from the audience at this stage? You can also, I believe, send them through the Q&A via the application, also anonymously if you like.
I have a question. Thanks for that, it was very good. The most important piece of paper at the moment, would you agree, is the cash flow projection?
100%, yeah. I mean, it always is for every business.
Isn't it?
Yeah.
And it's something which I think is beginning to happen more even fintechs are asking now for the cash flow, because that determines on the importance of the risk you're taking with individual exposures on the ledger.
Exactly. I mean, we're a small company. Cash flow is what we talk about every day. I used to work for Morgan Stanley almost next door, and at the peak of the previous credit crisis, I was trying to get support to do some restructuring that we needed to do, and the senior management said to me, every single senior manager said to me exactly the same thing. Yeah, you'll get the support. Now, the story you've got to tell them is, we're fine for cash. There's no problem with liquidity here at Morgan Stanley. There are no challenges. You can even give some numbers. I mean, why are they telling me this? Because even at big companies, you have cash flow challenges at a certain point, and they're the ones you can't hide from.
Another question there? Okay, we'll go back.
We don't hear. I don't hear it. Please.
Sorry, right. Lionel Taylor of Trade Advisory Network. Going back to the partnerships, is there a challenge that can come in around compliance? Where, as we know, banks are under increasing regulation and scrutiny, where the partnership with the fintech becomes close and closer, and then compliance becomes an issue, where if the fintech is judged to have done something slightly naughty or whatever, or controversial, the bank then gets tarnished with it.
So the question is, what is a reputational risk very much for a bank to partner with a fintech or earlier stage organization?
In the narrow experience that we've had with partnering with large multinational bank, I would say that there's probably a perception, it may even exist in this room, that there's an arbitrage somehow, like fintechs can cut corners that banks can't cut. That's not my experience in practice, because the rational business decision and often the technology that underpins the economic decision is really trying to get better data to support the same regulatory outcome. So everybody wants to run a clean AML, sanctions, OFAC portfolio. The question is, how good is your data and what's your confidence interval in the decision that you're making? So the discussions I've typically seen with banks are, it just doesn't make economic sense for us to invest that level of attention in delivering that outcome for the Vietnamese apparel manufacturer. I don't want to onboard them as a client. It's not, I've got this data on them that I really wish I hadn't seen that's adverse, and can I take a view on it? So I think from a partnership perspective, it's less, or at least in my experience, it's less a question of differing approaches or differing standards to the same risk. It's more about what is my propensity to spend time on the problem. And therefore, that's where I think a partnership can work well, because the fintech can say, well, for me, my unit economics and I'm addressing my client here, I have to address this pain problem for them, and therefore it makes economic sense for me to do so. You can benefit from that, rather than I'll take a view that you won't, which I don't think is a good sustainable basis for any partnership.
Tim?
I mean, I agree 100% with that, and you've got to focus on why you're setting up the partnership in the first place. So again, I used to work at KPMG just around the corner. And the reason they wanted to set partnerships up was because they realised that for all of the 10,000 people in the rather wonderful building over there, they were all incredibly smart people, and they thought they were the best of the best. But they acknowledged that good ideas were emerging in the market in fintechs, for example, outside of KPMG. And those ideas, because of the way KPMG works, would probably never arise within the firm. So they were setting up partnerships to kind of bring those super ideas into the KPMG ecosystem. I'd also say that partnerships have a very long courtship, just to continue with your analogy, for exactly that reason. You're kind of sniff testing each other for quite a long time.
Yeah, long dating process. I wanted to chat for a few minutes also on the changing macro. We had a great introduction from Arno from Allianz Trade. Investment grade issuers today, public markets are paying the same as high yield issuers about a year ago. Central bank rates are at an all-time high. This must have an impact on your respective businesses as well. Chris, maybe, how does it impact your business? How are you navigating those markets? Do you see the first signs of, for instance, a deterioration in asset quality?
Not to any appreciable degree at all. I mean, we certainly don't assume that benign environment will persist into 23 and beyond. And I think I have a very similar view, probably not so well grounded in science as the economic presentation earlier on. But I think the more tangible impact that we see very quickly is that on the sell side of the platform, the reaction of capital markets, and a very different reaction between public and private capital markets, to what is a fairly unprecedented gradient in risk-free rates, that the world, I think, is still reacting to that, both on the sell side of our platform and also on the buy side, because what was a traditional, high single-digit all-in works for me as an emerging market exporter. Is that now base rate plus high single-digit, or is that still all-in single-digit? Because that's a very, very different proposition. And I think that's still working through, but partly because the financial markets correct very quickly, and maybe in real-world exporting manufacturing land, that needs to percolate through. But certainly, I think it's the number one financial priority that certainly I have at Stern, is making sure that we keep in balance the yield and the risk-adjusted returns that we're obliged to provide our investors with, and finding the right sort of bid point there on good risk on the client side.
Kartai, in my experience as a non-bank fintech lender, I believe the banks take a bit of a binary decision when it comes to SME finance or SME lending. Either they finance the SME or they don't finance the SME. How's been, in your organization, let's say since the start of this year, how has the appetite for SME finance and SME lending changed?
In fact, our business is to finance SMEs. It's our core potential client.
Yeah.
And we are always looking for this kind of segment with higher interest rate, of course, because in this portion, it's a big, better yield business. However, with this lower growth rate globally and increasing rates of the costing, then this market will, I hope, and we expect, not hope, but we are expecting to see a deterioration in the portfolios according to economic environment. But of course, we always, the alternative finance and trade financials are always, they will keep funding these SMEs with their receivables. So it's our business, and we will do continues to. But of course, in the market, with the recent developments, I can tell that high risk, high return, low risk, low return. So we need to find a balance to have a sustainable profitability.
But you say high return, but at the same time, we've seen already a little bit that disconnect between public and private markets, where even investment grade public issuers today are potentially paying more than an SME in Europe for their factoring line. Tim, you must also be facing these points when dealing with investors.
So we're seeing quite an interesting dynamic. So we're relatively young. So take this data set as you will, but what we're seeing is that banks have made a choice about the business that they're going to support, and so the ones that we're working with, by definition, the banks are going to support them. And now they've made that decision, capacity is not a problem, and also the cost of funds, because the reference rates are going up so dramatically, in order to support the clients because their cash flow is constrained, they're actually reducing in some cases the margins that they're offering to their clients. So we've done, 20 trades over the last 12 months. With one client in particular, we've seen exactly that dynamic, another one that's emerging now. And that's consistent with conversations I've had with the likes of EY as well.
Okay. And going back to the opportunity which was mentioned before in this, or the counter-cyclical opportunity, are there specific products or business opportunities specifically that you think will be most appealing or attractive in this more recessionary time? Time, maybe?
I think for factoring industry, there is always opportunities during crisis and volatile times because many corporates and even SMEs, they are coming to our industry to cover their risk, to have cheaper funding and collection services. And after every single crisis, especially in 2008, etc., we always see a tremendous increase in our turnover. And in 2022 and after pandemic, we see that the average growth rate in factoring industry is more than 15%. And the NPL ratio and default ratio decreased below 1%. So I think this crisis and these volatile times give factoring industry an opportunity to make more business and make more assets on SMEs,
Okay, so
which will help to real sector, the real industry.
Yeah.
Which
of
is
course,
good.
we have a role here to do.
We have the role to play, right?
To promote and to support SMEs as the driver of European and the global economy. SME factoring is a short-dated product, 60, 90 days in tenure on average, I would say. Chris, do you think there's products that may not be faring so well in more recessionary times when it comes to commercial finance?
Yeah, I'm sure that, this is not a world we understand or profess to understand at Sten, and I'm sure it can be done very sensibly and very well, but I think things that have market value volatility associated with them, it's often easy to convince yourself that history is a predictor of future performance, and possibly when there are so many geopolitical and economic factors at play, it's much harder to predict those, and you get into tail risks. So our mandate, certainly on our platform, is to match risks very specifically that our investors have expressed appetite for, which are, generally speaking, credit risks. Those are insurable, those are hedgeable. But I think when you get into performance and market value or kind of goods-based risks, that those models, I'm sure it can be done well, but that I'm sure would be more of a challenge in a choppy environment. So we tend to focus on, for our client archetypes, and just going to the previous question, what's value for our client, or how do people think about product evolution or what they value from a relationship? It consistently surprises me, at least with the client archetypes we deal with at Sten, the pure value of certainty in being able to predict your partner. So the product doesn't need to be fantastically amazing in terms of embedded finance options or price or pre-shipment, taking performance risk, but to be well delivered and to be predictable in terms of capacity and timing, I think is a perennial
So good execution is key.
I think so.
In this market. Okay. One of the questions we received through the Q&A of the application is whether in the origination strategy, non-bank lenders may be getting some selection bias. So opportunities which already have been rejected by banks. Tim, is that something given your origination partners are banks that cannot place those products within their in their own organization? Are you afraid of that bias that you're receiving? Say an adverse selection of clients?
So I'm not afraid of that bias because you have to trust that every finance provider that you talk to is going to make a decision based on the merits of the opportunity that's presented to them. And we've seen, as I'm sure many people in this room have seen, that the alternative finance market is slowly coming into this space and is using a whole range of different techniques to dip their toe into the water just to make sure they really understand it. So things like using trade credit insurance and that sort of thing as an early stage. And what we'll see over time is their pricing will come down to something closer to the bank's pricing. We see a slightly different dynamic and that's that treasurers at corporates, they want to preserve their share of wallet for their key relationship banks, but have a bigger finance requirement than their relationship banks can provide. So we're often having conversations about, can you bring non-bank providers into the facility? We'll accept the slightly higher cost of funds that's associated with that, but we want to give them the opportunity to come in so that we can focus most of our business on the core lenders, and then at the margins we bring in the alternative guys. So we see quite a lot of that.
Out of curiosity, with those banks, what is a commercial deal you strike? Do you pay them an origination fee, or what's in for them besides helping their clients find the best?
Generally speaking, it's just helping their clients. Okay. So they just pay they charge the cost of funds that they charge.
They don't act as a broker.
Correct.
Okay. Yeah. Okay. Fantastic. Any other questions from the audience? Yeah, please, the gentleman here.
So, Eric Barner from GSCF. Maybe a question to you, Tim. You have many banks as partners. How do you deal with the confidentiality of the client's data of the banks? Are they asking questions? How do you manage this data internally, or is it not a topic at all for them?
So it's not a topic that the banks are worried about. We have a kind of legal infrastructure surrounding every different bank relationship, and then we have a very robust method of storing all of our data to make sure that there is no scope for cross-contamination. But generally speaking, the data we get will be direct from the corporate to us. So it won't be data the banks have provided to us, it'll be data the corporates have provided to us. But still exactly the same. You know, we take that side of things very seriously.
Okay. Any other questions from the audience?
Just one quick one, sorry. Do you also find actually that you are putting a greater concentration on who's running these businesses and what experience they have, not just the technology?
We tend to be focused on mid-markets and above. So whilst we do kind of look at and analyse the people we're dealing with, it's not a key part of the credit conversation. I wish it was sometimes, because we deal with some people who aren't as professional as we'd like in these mid-sized companies. But you know, for an SME, 100%, I think that's a key part of what you do, what you need to do.
Another question here?
Hi, this is Alejandra Hidalgo from IBB. Many corporates have legacy systems, and from the technology aspect, I can imagine it's often very difficult to extract the right data from those corporates. How do you deal with that?
Okay, so how do we get the right information from the corporate for their supply chain finance programs? Many ERPs out there, many treasury management solutions. How do we implement and integrate? Chris? Yeah.
I think it would depend on what's the context in which you're evaluating the corporate. So if it's as the seller of a receivable, then we'll be looking at risk on their buyer effectively. So it's relatively speaking, relatively straightforward to get either public information or private data on true credit risks and financial performance. I think if you're looking to analyse performance risk on trade or ID&V people or beneficial ownership, corporate substance, in our approach, we would rely on data that's told to us by anybody other than the seller, because that's true trade verification. It's not to say that you wouldn't be able to access a good information flow from a client, but that wouldn't be the basis of a decision. From that perspective, that's kind of a threshold point. But on true credit risk, and we touched on credit insurance earlier on, that's where we don't believe there's a monopoly on wisdom. Banks are very good at assessing credit risk. Insurers are very good at assessing credit risk. And there's plenty of methodologies there that are, I think, perfectly valid. And nobody has the monopoly on wisdom. So there's plenty of databases you can access on true financial performance. But on fraud or commercial substance or directors' connectivity or collusion, that's where we've invested heavily in technology so that we're not reliant on that corporate providing you with data.
So this is right at the heart of what we do at Silver Birch. And we often have clients who have grown by acquisition and have got to a point where they've got I had one conversation, and didn't do a deal with the client. There's 32 different ERP systems. We rarely meet that, but 2 or 3 is quite common. And it's difficult, first of all, to get the information, then to get them to describe what the data actually shows us, then to adjust it to get the data that we actually need in order to put the facility together. So it's hard work, and it takes quite a long time. It's probably the longest part of the deal. But by the end of it, we probably know more about their business than they do, because it's the first time they've had a holistic picture of the whole business. So one of the things that we're working on right now is being able to present that back to them in anything other than a kind of an anecdotal way. So we use it to inform our facilities and set the price of the portfolio, etc. But then to go back and say, did you realise that compared to telco XYZ, your collections are better earlier on, worse later on, etc., etc. We're trying to do that because we see that as something that we can add a lot of value to our clients in doing. But it's an absolute nightmare.
Okay, very good question. Igor.
Ecozax 46. Now, a question to Chris, because you just made a very interesting point that you can use some of your data to evaluate fraud, but you have no benefit of using your data to evaluate credit, if I understand correctly. Because it's interesting because you get reasonable history and reasonable size of portfolio, and one of the views a lot of fintechs have that we as data businesses, over time we have enough to make some type of unique assessment. Is this the case? Is it in your plans? Is it something that was planned but is not working, or is it something that shouldn't be even planned and it's just unrealistic because the public data are more extensive, in your view?
Sure, and perhaps I should clarify my comments. So, in respect of pure credit risk, I personally have a conviction that the fundamentals of credit risk are actually not that different to what they were 10, 20, 30 years ago in terms of the basics of longevity, size, and balance sheet depth, liquidity. I don't think personally, as a former banker, that necessarily a model has come along that says actually credit risk has been fundamentally misappraised for decades. I think that where fintechs have value, and if I think of some fintechs who specifically position themselves as we've got a better engine than you, they're saying we're using data in a novel way, or new streams of data, but basically putting them through a Z-score or an Olsen score or some kind of traditional PD. So in a factored context, where we're speaking for STEM, we're largely taking risk on G12 located investment grade buyers. That's not necessarily the biggest risk in our business as I perceive it, or I don't think that the marginal dollar we would invest in technology there would have as big a payoff as mitigating fraud and trade verification. So that's more of an idiosyncratic comment about STEM. But clearly there is value in the wider fintech space of people who say, my engine's better, someone like an Oak North, here's my predictive value, and it's because I've done something different. Maybe in the consumer finance context that works better. In our experience, in business to business or in large cap credit risk, that's not necessarily where we see it as acute a need.
Hello, Simon Marshall from Copilot. I actually think that credit risk management has changed, or at least the nature of the risk, and perhaps the nature of what you need to do about it, and how you stay on top of it. And Tim mentioned clients having 4 or so ERP systems. We have clients who have more than 300. And I think, therefore, one of the issues becomes connectivity. And I think that works at the other end as well, because I'm a great believer in financials. There are people who say that they're history, but I still think they have a very powerful role to play. But the nature of risk now is that often you need a wider variety of information, and you need to be able to stay on top of your risk. You need to be able to understand what's happening to your risk. You need to identify what are the really important red flags. How do I design my processes so that I've got the right red flags? And Chris, you gave the example of trade credit insurance, and the job they do is very, very different from the job the credit reference agencies do. But it brings us back, I think, to this issue of connectivity, because how do you manage multiple information sources as well?
Okay. Tim, maybe we're a little bit short on time, but what's your
Yeah,
quick answer on that?
if you've got four, I know that our clients struggle to understand the data they've got and what it means. So they're not assessing the risk within their business. If you've got 300, maybe it's harder because you've got so many different information points, or maybe it's easier because it becomes like grains of sand on a beach, and the aggregate effect is actually the one you're looking for. But you've got to actually think about it a lot harder to get to that view. So yeah, I agree. It's a challenge.
Okay. Maybe as a closing question, the gentleman there.
Yeah, Cassio from Oceano Capital. I think the question that poses to all of us that are potentially former bankers and now into a fintech world is industry sectors that we get comfortable with. So it will be interesting to hear from you all, because that also drives product liability insurance. If you have if you're financing an oil company and you have an oil spill and you have all this ESG around it. So it'll be interesting to hear how you're managing, each one of you have a different perspective to how you manage the industry segment where you're comfortable with the risk, and then the derivative product of that industry. If you are in the oil sector financing oil companies, how do you manage the product liability, and whether you get caught on the ESG public statements that we've seen is going around.
I'll have a crack at that one first.
That's straight.
Yeah. No, I mean, it's certainly in respect of if I take risk there to be in the widest sense, like reputational, as well as hard credit risk. As I mentioned, we have two-sided platform. We listen very carefully, and I think it is a irrefutable trend that the ESG is here to stay and needs to be embedded not just in something that you say to investors once in a while, but it goes through the whole business process. We have taken an approach where there are different investor mandates that we have. Some capital is purely applied or is purely invested with a view to making positive good in the world and making changes in sustainability and in all facets of ESG. And that will attract a certain investment mandate. And with clients, there is a very different envelope for deploying that capital that has to fulfill that mandate. In other parts of our investment strategy, we are a do no harm and very much neutral from an ESG perspective. But ESG, I think, to be running an investment mandate now without any reference to it, I think is totally unsustainable, for want of a better phrase. But on the credit risk side, you mentioned product liability. In our idiosyncratic model is not to take risk on goods. So we're isolating a pure monetary claim against the debtor, and from that perspective, trade dispute, product liability, any liability associated with goods is a risk that we have not got a mandate from investors to run, and therefore we don't run it. But I think there are probably many products that one could create that would have an element of performance risk or goods titling risk or market value risk. We've just taken a decision that we're going to focus on refining our financial product, selling money and owning money. But that's not to say there aren't other valid approaches.
Many shades of grey. As a closing poll, what percentage or portion of your business today is based or dependent better on trade credit insurance? 10? Between 0 and 100.
Business done or business going forward?
Outstanding.
Outstanding 0.
0. Chris?
We make heavy use of credit insurance, but I wouldn't say we have a dependency on it. So we have a mandate to invest on an insured basis, but we choose to do it out of risk management effectively. But it's more than 50% of what we do.
More than 50%? And for you, Kartai, as a bank?
For more than 50%.
More than 50%.
Is being insured.
Okay. Interesting range. Thank you, everyone.
Thank you.